Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 23rd of 2024. It started this week with retail sales, a number that came out last week. Obviously, very important for the health of the economy, as consumption represents about two-thirds to 70% of the total economy, and retail sales is a reasonable part of that consumption number. And you can see here we've got two different representations. We have the all-in on the left-hand side, retail sales in billions of dollars, and you can see the aggregate numbers in black. And then on the right-hand side, we've got retail sales control group, and that's by some estimates a more representative picture of what retail sales is because it's a subset of the overall retail sales group, which kind of like CPI, when you have core CPI and you back out things that tend to be a little bit more volatile and or harder to measure, frankly. That's kind of what we're talking about here. But what I want to point your attention to is in the blue line, that represents real retail sales. So that's essentially a deflated number by inflation. So it's basically after inflation, you can see that retail sales in the aggregate on the left-hand side is going up. But real sales not trending at the same altitude. You can see it's been a little bit lumpy, and we've seen a little bit of a retrenchment over the last several months in overall retail sales. And I think it's fair to assume the consumer is slowing down just a little bit. You know, we have less stimulus in the pipeline. We have less aggregate savings in reserve. And even though we have real incomes, real wages that are still positive, we do see increased credit card balances and delinquencies therein. So I think it's fair to assume that things are slowing down just a little bit, but we still have an upward trajectory in overall sales. If you look at it over a period of a couple of years, and especially on the right-hand side with that control group, things continue to move higher. So we need that line to continue to move higher if we're going under the assumption that we're having a soft landing with a new economic cycle emerging here over the next 18-24 months. Some more information on retail sales. You can see the on the left-hand side, this is the monthly data. The estimate was looking for 0.3% positive. It was positive, but not nearly to that degree. It was up 0.1%. You can see that in the red line there. Right-hand side from the census gives you a breakout of where that benefit came from. So gasoline, furniture, and home furnishings, building materials, etc., were the laggards. And you can see really hobbies and kind of the fun stuff was really the driver here. And you know, in many respects, that shows a kind of a healthy consumer. You know, if they're spending on things other than just the essentials like sports, hobbies, books, and music, then that's a sign that the consumer is in reasonably good psychological shape. Some data from Charlie Bolello. Again, retail sales. You can see here that on the top line is a year-over-year change, and it is up about 2% there. So retail sales positive. You can see the deceleration. This is what I was talking about with the consumer slowing down, even though the aggregate change year-over-year is still positive. But the rate of change year-over-year is decelerating. That's, I guess, my point there. But if you inflation adjust that, then you actually get to something that's a little bit more negative. Not tremendously so, but you know, something that people would tend to correlate a little bit more with a recessionary period. And again, as we'll see in a second, not a whole lot of feeling that we're going to get a recession. But clearly retail sales kind of slowing down just a little bit. Here we have manufacturing production on the left-hand side. That was positive. In fact, it was better than expected. Estimates looking for plus 0.3%. We got almost a full percentage point of gain in manufacturing, which I'll be honest with you, depending on what region you look at and what measure, it's been a little bit noisy lately. We know manufacturing's been rather challenged. just overall for a couple of really, I'd say almost about a year and a half now. But you can see here that manufacturing production, at least by this measure, which is I believe it's a Commerce Department number, it continues to kind of trend sideways, and you have good months followed by bad months, et cetera. You see capacity utilization is a little bit muted, and that has a little bit of back and forth to it as well. But you can see utilization over the last several years amidst this kind of manufacturing slowdown has actually gone down. Here we have University Michigan, some home and residential real estate metrics here. We've got buying conditions, which are exceptionally low. Interest rates remain higher for longer, as we say, and so that's kept mortgage rates elevated. You can see that expected change in home values. We've got home prices that are relatively sticky. We saw some deceleration about a year and a half ago in that, and then that picked up again. So we're now positively sloped in terms of home price increases. You can see that in the lower left there. June represent up 3.6%. Now this is the expected change in home value, so it's not observed real-time data, but this is just the expectation, which helps to drive that buying condition there on the upper left. On the right-hand side here, we've got kind of the derivation of the monthly mortgage payment and what that looks like, and you can see how elevated that is and has been really for a couple of years now, and it has actually gone a little bit higher. You can see P&I, principal and interest, is really making things a bit more challenging for especially first-time home buyers. Okay, here we have home equity divided by disposable income. So this is like the equity component of total net worth that one has in their home. And so what this is trying to tell you is that basically when home equity goes up, that savings rates tend to go down. So you have the savings rate in blue, and that is on the left-hand margin there, savings rate as a percent. We're down below 4%. You can see that, and this goes back to 1952. So this is a lot of data here. And we haven't seen a savings rate this low, honestly, since just before the global financial crisis. And that was an era of some degree of profligacy on the part of consumers. And so we're at that point again, but you can see the home equity divided by disposable income. And this is an inverted number. That's on the right-hand scale there. So home equity has obviously gone up with home values. And now we sit about 120%. And that's about as high as we've seen it in the time that this has been measured. And it's apt to continue to go higher over the next several years. And that would tend to portend a lower overall savings rate, which I say is good because it's favorable to consumption when you have positive real incomes. However, if you hit a slowdown, then that leaves less seed corn and money in reserve for people to manage their spending habits in that downturn. It just leaves us a bit more exposed in a downturn. Here we have a chart I thought was really interesting. 40 to 50-year-olds is kind of like that. Those are the peak earning years for most people. And you can see the degree to which those renters are behind on their rent payments. And that number has spiked up a little bit. You can see that, going back a couple of years, that number is close to 2.5 million. Now it's perking up close to 3 million. So you've got 500,000 renters in this really key age cohort that are struggling a little bit. So this is the chart I was referring to a couple slides ago. This is like this muted feeling of recession right now. You got 53% of the respondents to the B of A Global Fund Manager Survey do not expect a recession in the next 18 months. And you can see, like, basically in April and particularly in May, that number was a little bit higher. So maybe we peeled off a little bit there. Some of the data has been less positive, but still over a majority of fund managers don't believe we're going to have a recession. And you can see, going down, to the first half of 2025, you've got 16%. The second half of 25, you got 14%. And then second half here of 2024, you only have 8%. So, the feeling is not that great. In fact, it's fairly muted. Now we could have surprises, and I show this just to give you a sense of where the investment community is on this. Not to say that there aren't consumers out there that are feeling it a little bit worse than some people are. I'm just saying that this is where the fund managers' heads are at right now. Well, we have a busy chart here, but on the top hand side, I'll focus on that first. This is just, again, fund manager surveys showing you where their head's at. And, you can see the preponderance of data on that chart when you slide over from May of 23 to June of 24. You can see, basically no landing, that they were just going to kind of like continue on and like there's nothing going on, and that number's around a quarter of all respondents. You got 64% in this particular survey that are predicting that soft landing, which, again, there's data that supports that, and there's also data that we saw a year ago that was, that is almost 100% predictor of recession, and it just didn't happen. And so you see hard landing is only 5%, and that's the lowest number that we've seen in the series dating back here over the last year. Lower part of this chart basically shows that global growth pessimism, and honestly, we see data globally that seems to be perking up. You've got central banks that are reducing interest rates, which unfortunately is making the dollar very strong right now. But you see increased optimism, or in this chart, as it would suggest, is decreased pessimism, and you can see that here in these percentages, and this is overlaid against the S&P 500. We have a chart on retail money market funds. Been monitoring this for quite some time. This is driven by a number of things. I think in many respects, it's not necessarily dry powder. It's just a disintermediation of assets from the commercial banking sector, because they're not paying anything on those deposits, and they're moving them into the investment world and putting them in money market mutual funds where they can get 5 to 5.25% right now. So this is a tally of that, and you can see that we're about almost $2.5 trillion. It's a record high, and you can see the meteoric rise that we've had since October of 22. This is something that we've not seen in our lifetimes. It's an amazing development as banks really struggle with the cost of deposits relative to their earnings capability. Banks are taking the advantage of trying to increase their spread, and they're just not paying anything on these liabilities that they're taking in, i.e. their deposits. And so these deposits are, like I said, going into the investment world. Here we have a chart showing you the increase in foreign investment in the U.S., which I think is pretty important. So obviously you've got foreign investment in the U.S. There's a demand for dollars. It helps to strengthen our U.S. dollar, but also it's indicative of how foreign investors believe the U.S. market is the place to be, and that there are better returns here despite the strength in the dollar. You can see here, you've got both liquid assets, which would be, securities that you can trade that are fungible, and then you have hard assets, which real estate, and think about, those types of things, physical asset acquisition, and that number continues to trend higher. And you can see the nature on the right-hand side here of what they're investing in. You've got corporate equities, it'd be fair to say that a lot of these foreign investors are interested in investing in NVIDIA and trying to chase that caboose that's in the train pulling out of the station. But it's not just that. It's a broad-based impact. And you can see that basically, you have multiple key asset classes that are represented in this demand for U.S. assets. This chart is a little bit noisy, but what's interesting and my takeaway here is that you've got equity investors that, at one point were really focused on wanting, companies to improve their financial conditions. And that was a real big bugaboo for them. And that seems to be not as important now as it was. Certainly not as important as the return of cash to shareholders is. And, we have noted a fairly strong increase in buybacks of shares by companies, by publicly traded companies, and we see increased dividends, even though dividend yield on the market is pretty low right now, but we have a pretty high interest in paying dividends. And you can see how that has evolved over really about the last year and a half or so. More data from the Global Fund Manager Survey. Spent quite a bit of time with this particular document and some of the related documents here from B of A over the last week. And you can see sentiment, sentiment is pretty strong. And then, you can see here, and that this oscillates going back to the beginning of this century. Kind of funny to say that, but basically about 23 years, and you can see how it does oscillate quite a bit. But where we are now is not necessarily at a high, but there's an awful lot of enthusiasm. On the lower part of this chart, you can see that cash levels are currently about 4% overall, and that's pretty low. In fact, that's very low relative to the trend line here, the plus 20-year trend line. We'll continue the conversation here with regard to corporate balance sheets and liquidity here with these two charts from B of A. This is global research. As you can see on the left-hand side, it kind of corroborates what I've been saying about the interest in buybacks, the interest in dividends, the interest in making acquisitions. That's in the dark blue line. If you look at where we are now, that's inside that little oval. There you can see that the net buyback and acquisition number. Again, this backs out some of the Mag 7 folks, but it's back to near 2019 levels. And I think what's really profound in this, if you look at that light blue line, which represents a change in net debt, is that number's not going up at the same, to the same degree that we see share buybacks and acquisitions. So it just means that companies are using internal cash flow to do that. Now, as we slide over to the right, you can see here we've got debt to trailing 12-month EBITDA, and you can see that debt levels have gone up for non-financial issuers, ex-utilities, which is important because utilities typically carry a lot of debt because they're very capital intensive. But you can see that backing out those people, that we have some of the highest levels of gross and net leverage that we have seen, again, kind of like they're certainly above like pre-pandemic levels. So on this chart, we have kind of a depiction of what fund managers are staying up worrying about at night. And we can see those changes really over the last several months. You can see what they're worrying a little bit less about is higher inflation. You can see that number on the left-hand side is down to 32%. Now, it does represent about a third of all respondents here. So it is important. It's just not as important as it was. And so obviously we're interested in monitoring that. And geopolitics always seems to make the list, and there always seems to be something going on geopolitically. And then election is still on the minds. And if anything, as we edge closer to that date, that number might continue to eke up. You can see that number is really one of really the only one outside of a systemic credit event where that number has actually gone up over the last several months. And so election, economic hard landing, even though most of the fund managers don't believe we're going to have a hard landing. But again, that's one of those tail risks and one of those unexpected things that people do think about from time to time, even though they don't believe necessarily it's going to happen. It's just one of those fears and uncertainties out there that can drive the market volatility. So on the right-hand side, we've got, this is the question was most likely to be impacted, issues that are most likely to be impacted by the election, trade, I think that goes without saying. Even though both contenders, if you will, at least the apparent contenders, favor more isolationism, deglobalization. So trade is obviously very high up there in geopolitics, as it is over on the left-hand side, and then you've got immigration, taxation, etc. So now we continue with the survey results from the most recent batch of data that we have. So on the left-hand side, we've got basically 80% of investors out there feel like we're going to get, basically 2 or 3 more cuts over the next 12 months. So this is not just 2024. So this extends out to the middle of next year as well, because right now the consensus is that we're likely to only get 1 cut by the end of this year, and it would come after the election, so to speak. So this has been very much a moving target, because as you recall, I was always a skeptic on this, but the consensus felt like we were going to have like 6 or 7 cuts this year, which really didn't seem to make sense given the strength in the data that we saw. And so now that's been tempered back quite a bit. And then on sentiment, you can see here on the right-hand side, because that there is a feeling of at least 2 or 3 more cuts in interest rates on the horizon, that has driven sentiment to be quite bullish. And in fact, we're about the same levels that we've seen back in 2021, and then after the global financial crisis. So it's a very interesting dynamic, and this is apt to continue to change as we follow this data heading into the fall. Here we have profit margins expected to improve. Again, this is still fund manager survey data. So this is kind of like looking inside the psyche of the consensus investor out there. And this is why we see, certain areas of the market react well when you have, growth stocks that are catching a pretty strong bid right now, because there's a lot of optimism out there, and that corporate profit is going to improve now, not just for the Mag 7, but for all the companies. We'll see where, in the coming charts, where we feel like there's going to be a broadening out in the market. And what we see right now is a very narrowly led market with just a very small handful of stocks driving, the majority of the gain in the S&P, and most of the other stocks are just doing okay, as it were. And so, but you can clearly see that the expectation is that profits are going to improve, and then you can see down below that kind of their thoughts on the global economy, and that even though I think most people are expecting some general improvement in global conditions, you see below trend growth and above trend inflation is still kind of embedded in the psyche, and above trend growth and it seems to be improving a little bit, but you can see below trend growth and that sentiment trailing off. So there's a little bit of increase in optimism there over the last year. Now we'll go ahead and delve a little bit deeper into the value versus growth conundrum. We've got 3 little vignettes here for you, moments in time or stretches of time where we had significant outperformance by value. And obviously we've been talking about the fact that value has underperformed growth here over the last year and a half, and this is a pretty wide delta. It's a pretty wide gap. But you can see here that value generally does retrace that gap when there is one. Even though the path is certainly not linear. We can see here in the 1970s when we had, first of all, we had stagflation, then we had hyperinflation, and towards the end of that decade. You can see value did assert itself a little bit later on in that decade. And then you had the kind of the tech bubble leading up and into the tech bubble bursting, and at the turn of the century there, and value performed above growth, and even though growth was negative during that time frame, and we had a lot of high-flying technology stocks that really took it on the chin during the tech bubble bursting, and then conversely, in that period post-pandemic, the 21 to 23 era, we had a lot of choppiness, and we had certainly some really poor growth in terms of poor performance, I should say, on the part of growth stocks. Value was not much better, but it was positive. So I think if we have some patience here, to the point where the pundits and the fund manager surveys tend to suggest that value is going to reassert itself, I would tend to agree. So we've talked a lot about the narrow leadership in the market. We have the Mag 7, actually that is really almost a Mag 3 right now, and we'll talk about that in a second. But we've had some fairly strong earnings performance out of those folks, and so not too surprisingly, we've had strong price performance out of some of those folks. Now, the good news is that we do feel like the market is going to broaden out to some degree, and you can see on the left-hand side, at least from earnings estimates that are currently in place looking out into 2025, that we're going to have better overall participation. So the Mag 7 stocks are not going to have as nearly the same kind of growth rate in earnings as they have had over the last couple of years. But you will see here that in that red circle there that it's going to have a broadening out. So we're going to have better representation, better earnings from the rest of the market, which if you look at the right-hand side, we've got the equal weight index, which is a different representation, basically takes all 500 constituents and divides them equally in terms of their weight, as opposed to the capitalization weighted stocks or capitalization weighted S&P 500, which is reported in the financial press. And you can see that that gap is rather significant. And there are only a couple periods of time here over the last 30 years that we've actually seen that. And right now is one of them. But again, we feel like that is going to change, and that we're going to have broader representation overall from the rest of the market as we head into the next year or two. We have the S&P 500 dividend yield. You can see with some of the strength in the market how that's trended lower. We're not quite back at our trough levels, but we're very close. And you can see here at 1.32 or 1.32% dividend yield, really not that much. And when you consider that like 45% of the total market return over the last 25 years has come from dividends, then this is really telling you something about valuation levels. Here we have foreign holdings of U.S. financial assets. We talked about this a little bit earlier. Different chart. We've got Federal Reserve fund of funds data, and you can see that continues to trend higher. Strong demand for U.S. assets regardless of the strength in the dollar. Here we have emerging central banks and their gold purchases. I've had some questions on gold lately. Pretty interesting, and I think very valid questions, because gold is exceptionally strong. So, we see, in this battle of reserve currency, if you will, and, maybe the dollar is losing a little bit of steam, but it's still the overwhelming majority of assets being held in foreign central banks. The one thing that I do note, which is really interesting, is we've had a notable increase in gold being held in reserve on the part of foreign central banks, and you can see that in the chart here. We have market versus the Fed's dot plot, and you can see in that red dotted line there, that's where the Federal Reserve feels like interest rates are going to be over the next several years, heading out to the end of 2027. And then the smooth gray line is where the market believes it's going to be. And this is based on SOFR, which is kind of the metric that took over from LIBOR. And this is the futures against SOFR that kind of map out what the market expects. And you can see that it in the early part of this transition that are going to be lower than where the Fed dot plots are. Again, that's that optimism that we're going to have more than 2 cuts, and maybe the Fed is finally not that optimistic, but the Fed continues on, and they feel like these rates are going to continue to come down. And again, it's anybody's guess. And obviously, if I'd shown you the slide 2 years ago on expectations, all of the expectations would have been off base. But anyway, maybe a little bit of a grain of salt, but it is interesting nonetheless. And here we have global value versus growth, not just the U.S. And you can see here that this, over time, if you look at not only you look at the period since the tech bubble bursting, which is post 2000 there in the light blue, but if you look at all time, this is a relative performance metric uh, between value and growth. And so the fact that these are all positive represents that value has outperformed growth over all these times. So where U.S. Markets tend to oscillate between value and growth, although I'd say for the very long stretches, if you look over multiple decades, value has got an edge over growth in the U.S. markets. But overseas, these markets it's clearly favors value over growth, and so those are one of the things that we are trying to accentuate in our security selection. Here we have a difference between large and small cap, and we know that small caps are terribly undervalued relative to large caps right now. You can see that in this chart. We're basically zero point 0.7 or 0.68 times, and you can see the historical median is that from a valuation perspective, that you tend to see a price to earnings multiple a little bit higher on small caps because they tend to be higher growth, right? Well, certainly not the case right now. We see not only are small caps cheap relative to their historical mean price to earnings ratio, but they're significantly cheap relative to large caps, as we've noted. So feel like that's another area that we can exploit and increase our weightings in heading into the next year. So we have here an interesting chart I came across at a conference, and this is the AI bubble. And if you look at the top 10 stocks in the forward PE, you can see 2020 about 29 times. Forward price to earnings ratio, we're 27 now. And if you back out the top 10, which have this distinct AI focus, then that number drops rather precipitously. And right now that goes from 27 to 18, and then if you just look at the index as a whole, it's trading about 19 times earnings. So you can see that the impact of the technology stocks back in 2000, even 1995 was kind of like the front end of that, and you can see that those valuations really pale in comparison with what the AI stocks are driving right now. Well, I grant you that this is a very busy chart, but what this shows you is the equal weighted index, and that basically, we were talking about the market breadth, and we also talked about how we feel like that's going to improve, but you can see here, and I have to use the pointer on this one, but down here you see that 44. That tells you that 44% of the stocks in the index are trading below their 50-day moving average, where you've got the Mag 7 or the Mag 3, whatever you want to call it, those are trading above. That you have almost a majority, not quite, but almost a majority of S&P 500 constituents that are trading below their 50-day moving average. So here we have the weighting of the top 3 holdings. I've been talking about like the Mag 3, if you will. You've got Microsoft, Apple, and Nvidia, and those 3 stocks alone represent 21.1% of the index. And if you go back to even the tech bubble, like we were just talking about, that was Microsoft. Oddly enough, it was GE and it was Cisco, and those back then represented about 12%. And again, it's a very unusual market that we do have limited breadth, but we do feel like that's going to improve a little bit over time. Here we have job openings going down. This is the sign of a labor market that's kind of like it's losing a little bit of the froth, but it's not in necessarily a bad shape. If you look at this trend line here, we're kind of like back to trend. We've just kind of like, offset some of the reverberations and the, from the pandemic. It is true that, when you have these decreases tends to correlate with recession. Again, we haven't seen that yet, and there's not a whole lot of expectation for it. So if it were to transpire this way, it would be setting a new precedent. But again, in each of these declines, did we see something as dramatic and profound, as cathartic as the pandemic and the shutdown and all that was? So, this is why, this data is important to look at, and we're going to be writing books about all this stuff here in the coming years. Here we have credit card defaults, as we've been showing you. Consumers getting a little tired. Spending remains relatively high because we have relatively strong real wages, and so that's not necessarily a problem. But this is something that we clearly want to monitor. If you look back over time, this is and this is interesting because this is a delinquency rate on credit cards as reported by banks that are not in the 100 largest banks. So, I mean, we get data all the time from Citigroup, from JP Morgan Chase, and some of these really mega center banks. This is from kind of like mainstream America, and what we're seeing out of these small to medium size banks is that those delinquencies are definitely trending higher. Quick note on hedge funds. I've been spending a lot of time on alternative investments as of late, and really do feel like, in these different categories of alternative investments, whether you've got hedge funds, you've got macro circumstantial type investments, you've got event-driven things, and multi-strategy, I think credit, that when you have rates that are above 2.5%, that these tend to perform extremely well, which is the environment that we're in right now. So these charts really highlight a theme that I think is going to be very prevalent over the coming years, and that's the infrastructure investment theme. And you see it. I'll credit people that were on this early were Rich Bernstein. Listen to him and have hosted him for speaking engagements. Probably 10, 15 years ago, but Rich really was on top of this and recognizing that the infrastructure investment theme was certainly valid. So you can see that we have underinvested for a number of years here, and this is from B of A's, it's basically Federal Reserve data. And then you can see that the age of stuff, as it's entitled here, it continues to go up. So you've got private non-residential structures that are moving higher, and then you've got private non-residential fixed assets. So the average age is increasing. So we're getting long in the tooth on these investments. We haven't been spending to keep up. And at some point, push is going to come to shove, and we're going to have to commit more dollars to capital investment. And I think that's a real strong theme that you can see across many, many different types of industry. Well, the last three charts, I'm going to reference some work done by First Trust. And there are three on Thursday. I thought this is important as we head into the election season, and the rhetoric is going to be hot and heavy. We got the debates next week, which is one of the reasons why I thought about including it here. You're going to hear a lot about, well, the high income people need to pay their fair share, and you're going to hear a lot about taxes and, the disadvantaged people that have to, that we have regressive taxes, and there's just a lot of misinformation out there. And I'm going to take these last three slides to kind of highlight this. So, looking back to 1950 in this chart, government revenues have averaged about 17% over that time frame, and so we've had a lot of fluctuations since then. And we've been we had a peak of 92% in the marginal tax rate and a low of 28%. And so since 2018, which was after the Trump tax cuts went into effect, revenues have averaged about 17% of GDP, which is a little bit below their historical average, but spending over the same time was about 25% of GDP, and that's what has led to this deficit. So this is not the issue is not on the tax or the revenue side. It's the spending side, frankly. So on this slide, we have average income tax rates. So, what's really important here to understand is that, basically, the bottom 50% of the U.S. population pays an average income tax rate of 3.3%. And obviously there's a lot of people that don't pay any tax at all, but you can see this is not necessarily regressive in terms of percentage terms. Obviously, there's a lot less disposable income at these levels than there is over here, but the top 1% basically pay an average income tax rate of almost 26%. So you can see there's a marked increase as you improve your economic status. Okay, on this last slide, we've got basically a share of adjusted gross income paid versus the share of total income tax paid, and let's talk first about the top 1%. So just to be clear here, that's the 1% here. So they make about a quarter, a little bit more than a quarter of all adjusted gross income, 26.3 to be exact, but they pay about 46% of all taxes. If you go down to the bottom 50%, which we were kind of talking about, and there's a lot of people that aren't paying tax in this bucket, that cohort represents about 10% of all revenue, but they only pay about 2.3% of all tax. And so when you think about this in aggregate terms, this represents basically 1.5 million income tax returns, right? And so the bottom half, this represents 77 million tax returns. So really, really important here. And so when you look at the bottom 98%, account for about 150 million tax returns every year, and they account for 68% of the adjusted gross income, but they bear about 46% of all taxes, which is basically equal to what the share is here just in that top 1%. And so, it's very, very powerful statement when you talk about like the upper income cohorts not paying their fair share. Well, again, I'm not waxing politics here, but the data clearly shows that there is a greater share, much greater share being paid by this upper income cohort than the lower income cohorts. And these people have more significant discretionary income, where most of these people are, literally hand to mouth with their monthly issues. And so, even that 2.3% is a big deal to them. So this is where the argument kind of sets its root. But the data, if you're just looking at data, it clearly tells you that there is a pretty wide discrepancy there. That's all we have today. Hope you've enjoyed the chart pack, and I look forward to talking to you again very soon. Take care. Bye.